Good afternoon, everyone. So my name is Cédric Merle. I'm accompanied by Laure, Madeleine. We're both from the Green and Sustainable Hub, and today we are presenting you our latest piece of research on the social bond markets, especially our latest report titled Social Bond, Easy Come, Easy Go. So we are delighted to present you our findings. Just maybe as a wrap-up, we have been covering social topics quite extensively over the last years, notably the EU social taxonomy draft, also the momentum around fair transition finance, some standard initiatives as well, and from time to time focusing on some flagship social bond issuances, especially the program from the EU or transactions and frameworks from UNIDIC or CADES. Just to give you two examples.
All right, I'll start by giving a big picture of the Euro-labeled social bond market, which is key to deciphering the market and the underpinning trends. So even though there were already some issuances, the key event which truly activated the social bond market was, in fact, the COVID crisis. The volumes issued before and after more than doubled in the space of 1 or 2 years, reaching a peak of 105 billion euros in volumes issued. One reason for such volumes lies in the issuance of the Euro COVID bonds, which accounted for 1 billion euros by itself. In parallel, the number of social bond issuers also grew, reaching a peak of more than 80. And after the COVID crisis tampered down in the beginning of 2022, even though the volumes nowadays are higher than the pre-COVID period, the number of issuers as well as the number of volumes significantly dropped, reaching 60 billion euros in bonds and only 14 inaugural issuances. However, the number of yearly social bonds is more resilient, as it went from 84 in 2021 to 57 in 2022. So this brings us to a lot of questions.
Yes, we try to understand beyond the numbers of what was driving the different numbers, trying to provide some explanations and framing questions. So we ask ourselves whether it's a boom and bust, and we all wonder whether 2021 was the apex of the social bond market, or is the market simply undergoing transformations? If so, what type of transformation are we talking about? A key pattern we looked at is really the what we call the cyclicity and elasticity of the market. It appears that social bond issuances are highly counter-cyclical and elastic to crisis. Then asking the question whether the instruments is fit for ordinary time or for turbulent ones, and really answering to special events. And the question is then what type of events? Is it only about economic crisis, sanitary crisis, or other type of, let's say, large-scale events? We also looked at the eligible categories and bond types. We asked ourselves whether there was a competition between eligible social categories versus green ones, and also whether for the same issuers, whether there are arbitrages and whether issuer must pick one bond type versus another, whether they can be combined or with some rotation from a bond type or from bond format to another. So it's really about synergies or competition between the different GSSS bond instruments. Another key aspect is really about social spending. Is the user proceeds instruments an obstacle, a bottleneck? Because we might face difficulties to identify and segregate enough social product activities, loans, or so on. So is it an identification issue, or rather a lack of amounts and volume issues with a lack of projects and a limited scale to underpin repeat social bond issuances. Another question we asked ourselves was whether social, in its great diversity, is better captured through a KPI applicable at issuer level rather than at user proceed levels, and whether as well social is more of a risk, negative impact minimization topic rather than opportunities and contribution angle, which is the result of social bond. Another parameter questions rose about the value add of the social bonds, especially for issuers that are deemed as a pure play, the one that have a core social remit. Do they need such instruments? How helpful it will to be, and what does it bring to investors, considering they are very genuine social remits? And conversely, for companies whose business model and raison d'etre is not focusing on socials, and that benefits are only incidental, whether they should refrain from issuing social bonds. And all those questions about cyclicity, challenge to identify proceeds, questioning around eligible categories and so on, led also to questions around market concentrations and why is there so little diversification with very low participation from non-financial corporates. So those are a few questions that we asked ourselves when we launched that investigation, and we are very delighted today to share with you our conclusion, our finding, and also a bit of a forecast about how the market will evolve over the next years. A reason for that, and it was also that study was a good opportunity to wrap up on what we call significant social contributions. Social matters are very diverse and very intertwined, and they're less clear-cut, much more heterogeneous than for individual ones. You can define social contribution through different lenses. It's a matter of locations. Sometimes the social impact is achieved by targeting special territories, disadvantaged areas, locations that have been stuck, hit by extreme weather events. So it's about places, but it's also about context and situations. Of course, we mentioned the COVID-19 crisis. The inflation crisis is another one. So is it only in special circumstances that the social impact revealed to be higher? Another way of defining social contribution is by looking at categories and activities. This is the most usual way in social finance to frame contributions. It's through the end use of the purpose of an activity or of a product. Let's talk of social housing, of healthcare services. So that's the ordinary way of defining substantial contributions. And the last one, which is very important in social finance, is about target populations. It's about benefiting individuals, households, counterparts that are more vulnerable, that have specific patterns compared to the rest of the populations. And it requires to identify such situations, should it be in terms of level of income, in terms of illness, in terms of unemployment, and so on. So this is really about the who benefits from a given activity, project, and programs. And as you can see, it's very diverse, multifaceted, and sometimes you have a mix of those different angles, while in the meantime, and also contribution is more straightforward, revolving, of course, around reducing greenhouse gas emissions, biodiversity, resource management, but it's more, again, more straightforward and much more on the, let's say, the product categories and activities than for social matters.
So another point that is noticeable about the social bond market is its high degree of concentrations. So just to illustrate this fact, the volumes of 3 issuers in the euro-labeled market, so EU, CADES, and UNEDIC, make up more than 65% of the total volumes issued in euro. So this is a big part SSAs, so supranational sovereigns and agencies, are clearly the most prominent, and this is what you can also see on the graph. They represent 52% of the total issuers overall, and especially supranationals like the EU are very active in this field. Another thing we noticed is that there are very few sovereign which have issued a social bond, but we'll tackle and we'll explain these reasons later during the presentation. It is important to stress that SSAs have highly cyclical emissions, and because these issuers tend to mobilize a large quantity of capital depending on the needs of the markets, and they're also able to define and label their emissions as social. On the other hand, financial institutions are also very present on the social bond market, as they can mobilize capital for social infrastructure. However, this is not the case for corporates, as they are less visible on the social bond market, even though some might have a social remit, such as corporates in the food and beverage sector, for instance, but they're not very active in this field. And this can be explained by low social capex, for instance. And in contrast, and I'll show you later, the corporates are a bit more visible on the Euro-label green bond market, which is much more fragmented and diverse. So this is the case here. And SSAs are therefore an important player in the social bond market. So one thing we can ask ourselves after seeing these two graphs is what the social bonds are focusing on and to which categories do they allocate the most capital. So according to our findings, we found that SSAs mostly focus on two categories, which are employment generation and access to essential services. And as we have outlined here, the EU represents more than 90% of access to essential services allocation for Euro-label bonds, which is a big chunk. And in parallel, UNIDIC, which is also a very famous social bond issuer, mainly focuses its allocation on the eligible category, which is unemployment generation. Another angle that is revealing is the populations that are targeted by social bond issuances. The most recurrent ones that appear in frameworks are those which are living below the poverty line and those who are aging populations and vulnerable youth. And what we want to show you is that there is a gap between the categories mentioned in the frameworks for each issuance and the actual estimated allocation on the right. So for instance, even though affordable housing concerns a quarter of Euro-labeled social bonds, it only sums up to 9% of the estimated allocation. And it's also important to mention the differences between developing countries and developed countries in terms of issuances and volumes. So we noticed that the developed countries concentrate their issuances on access to essential services and socio-economic advancement and empowerment. And in parallel, emerging economies focus more on socio-economic advancements and affordable housing. It is worth mentioning that some supranationals, which are listed as developed countries issuers, are predominantly involved in emerging countries' growth through social bond, for which they represent approximately a third of the total volumes issued. So this is another illustration where you can see the best allocators for each eligible category. So this leads us to ask ourselves what the specificity of the penetration rate is for social bond. So the penetration rate is the share of social bond or green bond in issuers' debt financing. And we found it interesting to compare the social bond penetration rate to this to those of the GSSS bonds overall penetration rates. So from 2019 to today, the GSSS bonds penetration rate experienced a boom and stagnated after. In contrast, the social bond penetration rate is not the same because it was very low before the COVID crisis. It has peaked at 24 during the COVID crisis and quickly dropped after this. And even though penetration rates now are higher than before 2020, they still stagnate around 5 to 6%. And these fluctuations of the market and of issuers' behavior must be analyzed through the lens of cyclicity and elasticity.
This is really a key pattern to look at how the market is reacting to the situation and to the context. This is striking, especially for some issuers and for some categories. But what we observe is that major events, economic and social cycles, are really impacting the volume issued. This holds particularly true for Europe. So as explained by Laure, the total volume of emission dropped by 43% from 2021 to 2022, while the number of issuers was rather stable. A question we were asked by some clients was to say, okay, there was a crisis with the COVID, but since then we've been through other type of crisis, namely two, the invasion of Ukraine by Russia, but also the inflation crisis. So why did the market not swiftly react to such categories? Okay, go back on the slide. And out to the global inflation surge. So there is a lag most of the time between an event and an economic crisis, then the reactions to this crisis, the measures that can be adapted, and then ultimately how those programs, those projects are ring-fenced through social bond issuances and then allocated. So is it a question of timeline? We don't think so, because most of the framework have been set. It might be about other aspects, notably the type of let's say, countermeasures that have been adapted. And also, it's also a matter of timing in the case of Ukraine. So, in the case of the fight against inflations, there was massive spending, especially again from sovereign and from SSA to support households or companies to contain, to mitigate the effect of inflations. But we haven't seen that in the social bond market figures. There is a reason for that, is that the big part of those countermeasures were related to fossil fuel subsidies. It was mostly to allocate the cost of energy prices increase, but all those expenditures, although being social and helping those households, have had very negative impact on the organizations, and as such, we're barred access to the small finance market because there is this logic of do no significant harm. In the meantime, beyond those fossil fuel subsidies, there was also a massive increase in clean energy investments, with total spending increasing by 0.1 trillion in 2022. So we need to wait and to see whether green bond volumes will increase with a boom in amount allocated to renewable energies. So that's for the inflation crisis. When it comes to the Ukraine, we have seen some related issuances, mostly from the Council of Europe, which has been issued through time social inclusion bonds to support refugees, support and assistance. So proceeds finance social loans to support refugees and host communities with different type of schemes. We had also another examples with Canada, which issued a Ukraine sovereignty bond providing essential services, notably around pension and fuel subsidies. But except those two examples, there were little noticeable consequences on the market. Why? Because it's not easily recognizable and identifiable, and also a big part of the support was achieved through weapons and military support. That's true that investors have changed a bit their mind when it comes to defense and about defending sovereignty and protecting, standing for human rights and rule of law. But still, it's not eligible as a social spending. So this is a reason leading to that stagnation of the volumes. At some point, when we will be in the reconstruction phase of Ukraine, and on top of that, it's access to the EU because of the membership. We can anticipate major reforms to rebuild the country, to rebuild utilities and infrastructures. So a number of supernational moves, possibly some corporates being involved in the reconstruction of Ukraine. We can expect changes on the market. With a huge amount of capital being mobilized. There are some calculations that have been made. They're astonishing, with several $100 billion euros needed to rebuild Ukraine. And as the war continues, we can expect that total amounts are necessary to continue to grow. So this is a bit of the explanation between the inelasticity to those two crises.
So this leads us to the question of arbitrages between issuance types, bond types and formats. So globally, including all the currencies, more than 200 issuers have chosen to finance themselves through a social bond. And out of them, 4 have also issued SLBs, and 87% have also issued green bonds. We noticed that only a few rotate between different GSSS bond types. So we tried to find a reason for picking one bond versus the other. We think that it could be because of the availability of proceeds and the time necessary, that is to reload a very large pool. It can also be explained through the demand from investors or even the availability of data for impact reporting. But these are some of the main reasons we found, but maybe there are others. So therefore, we found that bond types have a very hard time coexisting, as each bond doesn't fit the need for all issuers, and social bonds are not fit for all issuers. But nonetheless, social bonds are not the only type of financing instrument that allow issuers to take into account social themes. And it is interesting to find out the specificities of other bonds, which incorporate social aspects, such as sustainability bonds and then SLBs. So for sustainability bonds, they mix both green eligible categories as well as social eligible categories. As of today, approximately 100 have issued at least €1 denominated sustainability bond. And this market is clearly less volumetric and only represents a little bit more than 172 billion euros on the euro-labeled sustainability bond market. And just like social bonds, SSAs are leading the way, representing 43% of issuers and 81% of the volume. SSAs are then followed by FIGs and corporates, just like social bonds. We also noticed that many corporates in the telecom sector, some examples on the right of the slide, have issued a sustainability bond. Diving into the categories of the sustainability bonds themselves, we found out that issuances tend to focus more on the categories which are access to essential services and economic advancements and empowerment. And according to our research, we found that social categories receive more than half of the allocation compared to green categories in sustainability issuances. And another type which takes into account social aspects is the SLB format. So SLBs are bonds for which the proceeds are not ring-fenced to green or sustainability purposes, unlike the use of proceeds green bonds or sustainable bonds. And the proceeds may be used for general corporate purposes or other purposes. And the achievement or not of sustainable performance targets that the issuers define for themselves can alter the financial structure of the bond. It can, for example, alter the coupon. So there are several distinct situations for choosing a sustainability bond format instead of a social bond to address social impacts. Some issuers cannot access the social bond market that easily because they lack identifiable eligible expenditures, and they may consider that KPIs are a better way to capture their efforts in social aspects, and KPIs may also be a better way to reflect their impacts. Other issuers may be discouraged by rigidity of the ring fencing needs and the very harsh reporting processes. So this may be the second reason. More than 10 euro labeled SLB issuances have incorporated social KPIs, which a sample of them are shown on the slide. Social KPIs themes can vary, and they most often concern diversity. So workplace diversity, for example, or gender diversity. On the contrary, the sustainability linked bond market is differentiated by the issuers because social KPIs that are included in SLBs mainly came from corporates this time. And these SLBs represent more than 90% of the volumes issued. And as the profile of issuers is different according to the bond types, the social themes that are being tackled are not the same. Again, diversity and health are prevalent across SLBs, whereas on the right you can see that the split of social themes for social bonds is more focused on meeting basic needs, such as access to essential services, affordable housing, and employment generation, for example. So now we can tackle the question, what does the future hold for social bonds? One key aspect for this is the investor side and the investor's point of view. So compared to green bonds, as Cédric said, themes present in social bonds are unquestionably more diverse, and as a consequence, they are less straightforward. And social bonds can help address issues that are very diverse. They can be localized, global, urgent, or for the longer term. Social bonds can even encompass multiple themes and topics. Also, in parallel, the market is very restricted. We've seen that for green bonds, more than 5,000 green bonds have been issued, all currencies included, while less than 1,000 social bonds have been issued. So the lack of available supply in social bond is a reason for the limited number of social bond funds that we have listed on this slide as well. And as investors mainly aim for portfolio diversity to reduce risk, this can also be an explanation. In addition to the limited supply of social bonds, producing an impact report for issuers is also a very difficult task to carry out, as social metrics can be more of a qualitative nature. And this is what Amundi has highlighted in its impact reporting for the bond. So the future of social
maybe so. Indeed, there is a lack of diversifications. We touch upon the absence of sovereign issuers. So out of 23 sovereign issuers that have issued a GSS bond, 6 have issued a sustainable bond with social categories, mostly related to essential services and employment generations, accounting for respectively for 8 billion euros and 33 million euros in allocations. Question we ask ourselves for sovereign was, but are not one can argue that states are social by their very natures, and there is a practical issues around delineating social expenses from non-social ones. When you look at the entire state budget, it's a bit puzzling to differentiate and to discriminate. What should you include between cohesion expenditures, solidarity, insertion, education on one hand, and of course you have some regalian functions around social order and border defense that are deemed as less social by their very purpose, but that are above all of a different type. So we observe and we infer that there is some reluctancy to discriminate, because it could feed endless political debates about spending eligibility and also spending efficiency. Can we say that any education spending is social by its very nature, regardless of the results of the policies on the inequalities that are either enlarged or narrowed by the education, let's say, reforms or programs? It could be very challenging and little consensus. That being said, what we observe is, especially in the case of emerging countries, is that welfare-related expenditures are deemed as more acceptable from a social point of view, especially on health and education, although I took the example of education impact on the inequalities and so on, and that the debate, another key debate, is around target populations and vulnerable one versus the general populations, because all those states have a redistributive role to play. They must guarantee equality, and discrimination is not always accepted. So in terms of schemes and programs, there is a challenge about embracing the entire budget and the entire population would benefit from public services, or only the people in a very in distress and in jeopardy. And as an example of that, we have seen very little presence of displaced persons, migrants, and marginalized populations being mentioned in the frameworks. So I think that's a reason behind the little footprints of sovereign of states in the social bond markets.
All right, and so the next question that we can ask ourselves is the future of social bonds. What does it look like? So we are tackling two axes today. The first one is the push from EU regulation. So classification efforts on social matters are limited. There was an initiative for the EU social taxonomy, but it is still on hold. But social matters can be handled through other regulations, which are not product-based, the most important one being CSRD, so Corporate Sustainability Reporting Directive, because it will incentivize companies to report on a few standards and KPIs, which are defined by the ESRS. And in addition to this, the CS3D, so Corporate Sustainability Due Diligence Directive, is supposed to be implemented soon, so starting 2025, and it will necessarily strengthen the diligence on social matters by requiring more than 16,000 firms to establish, as well as publish and implement a vigilance plan as per duty of care.
Another topic which is promising from a market development standpoint is on fair transition. And this is a point we really want to stress, is the interplay between green and socials. And there is indeed a momentum around fair transition, which consists in making sure that stakeholders, should they be workers, employees, customers, riverside populations, benefit or at least do not suffer from the transition towards a low carbon economy. And as the transition is being stepped up, it is destroying some capital, and there is really a need to protect, to shield segments of the populations against, to take an example, fuel poverty. And what we have seen is a growing mobilization of investors, of market participants to identify the risk, to anticipate them, and also to incentivize corporates or SSA to protect and to make sure that the green transition is not at the expense, is not pursued at the expense of the most vulnerable. And as evidence of that, we've seen in some frameworks, to mention, for instance, Renault, which does include a fair transition eligible user proceed category in its sustainable framework. It encompasses reskilling and upskilling programs for the employees, and notably through the Renault and University project. So this is really about providing the skills to employees to accompany the switch from fossil fuel vehicles to electric vehicles. So really accompanying the transition in terms of job, in terms of skills. And this is a trend that will go larger over the year, and which will also be very territorialized, because we all know that especially fossil fuel industries and the other ones that must shrink or even be phased down are highly localized in some territories. So this brings us back to the initial questioning about social contribution, whether it's about a context, about some stakeholders, about some projects and activities. And in the case of fair transition, we have a mix of both. And this is a really key pattern. Doesn't mean that we will have plenty of fair transition social bond issuances. What it means is that at least there will be criteria, there will be requirements around the social component of the transition. So meaning that every issuers of green bond at some point will have to provide data to explain how the social consequences are being monitored and tackled. Meaning that the boundary between social and green is increasingly blurred as a result of the energy transition, and that only looking at social through the numbers of social bond issuances is too narrow and narrow-minded. It does not reflect the importance of social matters, which is also driven and fueled by regulatory developments mentioned by Laure, including on risk, on value chain traceability, and also on human rights abuses, which are making the headlines, that are more of a controversy angles, but that are also key in sustainable finance products through either DNSH or social minimum safeguards, and consistency between green green programs, and let's say the human resources, the worker conditions, and so on, that are also looked at and scrutinized by investors and other market participants. So thank you so much for attending that webinar. We are very keen to get questions and to answer. Should you have any remarks, observations, or questions? So the floor is yours. You have a Q&A sections in which you can type your questions. Nothing for the moment. So you can see on the slide a few articles that we published. We did mention on the social taxonomy proposal, how it's being structured and so on, although it's on hold. On the GSS sovereign bond markets, and fair transition, as said before, and also on the EU. Another topic that we're delving into at the moment is on strategic autonomy and securing supply, especially of critical raw materials, with far-reaching both environmental and social consequences. So this is also more than a new trend, really a new constraint and a new requirement in the financial and investment domain. No questions. We assume it was super clear. So we'll stop here. Thank you so much.
Thank you.
Feel free to reach out either by email. We will circulate the slides, and we'd be more than happy to set up bilateral meetings and to clarify or to dig into some aspects. Thank you.
Thank you.